All right, so chapter 12. Chapter 12 is a lot like chapter 6. I believe it was 6, or I'm sorry, maybe it's 5. 5 was the worksheet where we go in and we complete the worksheet by doing the adjustments, and then we calculate a new adjusted trial balance, break them out into the income statement column and the balance sheet column. Everybody remember that? Okay. So the only difference is we're going to have more adjustments than we had before. Remember then we had prepaid rent, we would adjust for that, and we would adjust for supplies expense. What was the other one? Depreciation. What we're going to add now is, remember we've learned how to calculate interest on notes. So if there's a note receivable or payable, we're going to calculate the interest expense or the interest income from that. We've learned how to actually calculate the depreciation, so we're going to do that. So there's just a few more adjustments there. The big one is going to be, what do we do with inventory? Because prior to chapter 6, we did not have inventory. Starting with chapter 7, we now have inventory, and it is part of our cost of goods sold, right? We've been building that up a little bit, as we've gone through this. Purchases, returns, allowances, discounts. And now we're going to work through the whole series of inventory. We had some at the beginning. We bought all this stuff. Here's what's left at the end. So we must have sold the difference. And that's our cost of goods sold, right? So let's just work our way through it. Okay. The whole point behind making adjustments is to make sure that we're complying with the accrual basis of accounting. And if you remember, under GAAP, accrual basis is the appropriate way to do things because you reflect all of your expenses. It's the matching principle. You're matching your expenses with the time period where they generated revenue or sales. Good? Everybody good? All right, we're awake. So it has nothing to do with cash. Cash is a different basis. And if you're recording things on a cash basis, it's did I get cash? It's not a sale until I get cash, and it's not an expense until I pay the cash. Accrual basis has nothing to do with the cash part of it. If you use the utilities because the lights are on, you've incurred an expense, even though you haven't paid for it yet. Okay? Revenue, you always recognize that when the sale is complete. What were the elements of a completed sale? Does anybody remember? Well, you've agreed on a price, correct? You've performed the service. You've made delivery, right? You've performed the service or made the delivery of the goods. You have an agreement, and you have a reasonable assurance that you're going to get paid. So you can accept the guy's promise to pay later. So if all those things happen, then you've got a completed sale and you record it. A sale is complete when the title of the goods passed to the customer or when the service is provided. You can't follow me over there, but
you want me to?
Yeah, that's the hard part. You got to kind of swing it back and forth. So again, when the goods pass to the customer, the service is completed, the price is fixed, and you're reasonably assured you're going to get paid. Expenses. I keep using the utility bill example for expenses, right? You run a factory, the lights have been on, the machines are running, you're using electricity. You've used electricity all month. When does the bill come from PG&E? Later. It usually comes in the month after you used it up. But you want to match that expense with the goods that you created in the factory during, say, the month of January. So you have to make an estimate of how much you think that bill's going to be, and you record it at the end of January as an expense. And the other part of it is a payable. It's a liability. Everybody remember this? Okay. People are nodding their heads yes. That's good. It's the matching principle, yes. The other one that we learned, do you guys remember? We calculated an allowance for doubtful accounts, right? Bad debts. So what's the one thing we know? If we give our customers terms, we allow them to pay in 30 days or 60 days, what's the first thing we know? Somebody's not going to pay you. Exactly. So we make a calculation of what we think the bad debt is going to be, the amount they're not going to pay. This is called an estimate. What do we know about every estimate? It's wrong, but it's our best, it's a guess. It's our best guess. And we have some formulas and methods of doing that to make sure we make the best guess that we can. Okay? Estimate. You can call it a guess in class. Out in the real world, call it an estimate. It makes you look smarter. Okay? So part of our adjustments are now going to be the allowance for doubtful accounts, the estimate of what that uncollectible receivables are going to be. Okay? We've gone over how to calculate the allowance for doubtful accounts, yes? Or was that my other class? All right, I'm getting my two classes confused. So, here we go. There's ways to do this. Remember, when we make a sale, we know somebody's not going to pay. And historically, in a company, there's a percentage of people who aren't going to pay, and it usually doesn't vary over time. So, this year will be the same, last year will be the same, and it's usually, I'm going to make up a number right now. Say 2% of everything we sell on terms, where we give the customer credit, we never collect. And the number tends to stay the same throughout long periods of time. Each company will be a little different, but if you walk into any company, they've got data that you can sit down and calculate what that number is. So we're going to use that history to anticipate what's going to happen in the future. Okay? That's called the percentage of net credit sales. And what the percentage of net credit sales is this. If we have total sales for our company of, say, $100,000, okay, typically there are some customers who will come in and they'll pay. So we've got what we'll call cash customers, and let's say they are $30,000 of that. And the credit customers, these are the trade receivables, or the guys that we allowed 30 days to pay. That's the other $70,000 of our sales. Everybody follow me? So if we're calculating our uncollectible accounts expense, our allowance for bad debt, based on net credit sales, you don't use the total up here. We're just going to use the credit amount. Maybe I need to slow down a little bit because I thought we had covered this earlier. No? Everybody's good with the concept? The whole point of this is when we make these sales, and I just want to repeat this one more time, I'm sorry. When we make a sale, we know what the revenue is right now, correct? So say this is May, right? Okay. In May, we have $100,000 in sales. And we record that as sales, and then we've got our utility bill and our wages, and we come up with net income, correct? When do we find out that the customer isn't going to pay us? 30 days later. Yeah, it won't even be then. 30 days from now, in June, the customer hasn't paid, and we start wondering, hey, what's going on? So maybe we start calling him up. I'll pay you, I promise, okay? You wait a week, you call him up again, hey, I'm going to pay you next week. Everything's good. You call him up the next week. Oh yeah, I'm waiting for this guy to pay me. I'm going to get some cash, I'll pay you. So this goes on for 4 weeks, 8 weeks, however long you let him string it out. So it could be 90 days. It could be June, July, August. It might be September before you finally say, this guy's not going to pay me. So if I'm in August, but I recorded the sale in May, what do? Right? I have this matching principle where I want to match this bad debt with the sale that I made in May. but I don't know how much it is, right? So that's why we're making this estimate. We're going to estimate how many people aren't going to pay us out in August and September for the sales that we made in May, and we're going to record the expense on our income statement in May. And that's the matching principle of accrual accounting. Everybody follow me? Okay. I feel better taking a second to explain it in a little more detail. Yes?
What happens if you don't estimate enough?
As with any estimate, we know it is wrong. And what we'll do is we'll adjust it later when it works its way out. Okay, so any other questions? All right. So there's a couple of methods that we're going to focus on. One is the percentage of net credit sales, and that's what I had started to jump into here. So here we have May. We had 100,000 in sales, 30,000 in sales where the customer paid us at the counter, right, when they picked up the goods. 70,000 where the customer signed the invoice saying, I promise I'll pay you in 30 days. And under the percentage of net credit sales, you take just the credit amount, the credit sales amount, the $70,000, and you multiply that by your historic rate of what percentage of people don't pay. And in the example I came up with a minute ago, I said 2%, right? 2% of $70,000 is $1,400. So I'm guesstimating that out of $70,000 in credit sales, I'm never going to see $1,400 of it. And I want to record that as a bad debt expense, right? Because it's a debt, he owes me money. So we end up with a journal entry for that that's a debit to bad debt expense for $1,400 and a credit to allowance for doubtful accounts. And that's also $1,400. Okay? So that would be the entry. Yes, please.
Is this an entry that you do like every month? So the balance will change on the credit, so then you do depreciation?
Right, so this was May. Remember I called this May? So in June, let's say you had 80,000 in total sales and 40 of it was in cash and 40 was for credit. You would do the calculation on the 40,000 credit sales and you'd have a new entry. And part of where we're going with this is one of your adjustments now on the worksheet. That's the time and place where you stop and make this calculation and make the adjustment. Okay? Before I move on, I want to cover presentation of this. I'm going to use the very first example that we had in this class, which was fixed assets, right? If you buy a piece of equipment, how do we expense that piece of equipment, match its cost with the periods that it produces revenue? Depreciation, correct? So to figure out what book value on your equipment was, you would always take the cost less your accumulated depreciation. So if it was a $20,000 piece of equipment, $5,000 in accumulated depreciation, it was $15,000 in book value, right? So to figure out what my total value is, you have what we called a contra account that offset the original asset. This works very much the same. You've got this asset called accounts receivable, and let's say it's $60,000, and you've got less allowance for doubtful accounts. In this case, it's $1,400. Net realizable accounts receivable. 58.6. So on your balance sheet, you're actually going to show it this way. You're going to, cash, accounts receivable, less allowance for doubtful accounts, net realizable. And we'll do this as we go through the night. I'll show you an example of a balance sheet. But I just want you to realize that these go together, and you do have to combine the contra account with your accounts receivable to get the net realizable balance of your accounts receivable. Yes, sir?
So when we write someone's debt off, then we debit the allowance for doubtful accounts?
Excellent. I'm going to throw some T accounts up here if you don't mind. So we've got accounts receivable, and we have $60,000 per my example, correct? And then we've got allowance account, which we credited for $1,400. So that's what it would look like in the general ledger when you posted this. Let's say somebody doesn't pay. Customer, I don't know, pick a name, anybody. John Schmuckowski, it fits, right? He didn't pay us. John Schmuckowski owes us $900 for this invoice, and we determine he's not going to pay us. So when that happens, we will make an entry that reduces accounts receivable. It comes right off of his, the invoice goes away, but we reduce the balance in our allowance for doubtful accounts by the same amount. So my net realizable accounts receivable would remain the same because my AR goes down and the allowance goes down, so I'm subtracting a smaller number. Okay?
It would only go down if it exceeded the allowance.
Correct. All right, so any questions before I keep going? So I want to walk through the whole process, and we'll do that in the slides. But I want to point one thing out. Remember when we calculated the allowance for bad debt, our expected amount that we would not receive? Notice I expense this right there. I've got a debit to an expense account in the month of May. So I've recorded the expense in May already and set up this allowance. In August, when I record the entry where I actually write off this guy's account, notice I don't record it to an expense again. Why? Because the expense was here as part of setting up the account. Good?
The allowance is a liability account.
The allowance is a contra asset account because it goes right up in your asset section of your trial balance. It shows up with your assets on the balance sheet, and it serves to reduce your accounts receivable to give you your net realizable balance of your accounts receivable. All right, let's go through some of the slides and we'll keep going. And we'll do some examples and kind of clarify this as we go. So as I was saying, every company has experience over years of customers not paying, and it's really amazing. You wouldn't expect this to be, but that percentage of people that don't pay stays pretty constant. It's just a fact of life. So once you find out what that is, it's usually a good estimate to use as you go forward. So we're going to do an example here. All of a sudden I can't talk. We're going to do an example where we record the expense for uncollectible accounts and set up the allowance. Remember, we're setting up I want to use a different word. We're setting up a reserve. You know, we're setting money aside for that rainy day when we figure that the customer isn't going to pay us. So we record the expense now and we set up the reserve for later. Does that help you to think about it that way? Good. Okay, so we've got $32,000 in accounts receivable. In this case, they calculate the allowance to be $10,050. So you get your net realizable accounts receivable. That's your presentation on your balance sheet. Hang on. So there should always be a balance in your allowance, right? Unless you've got a brand new company, there's going to be a beginning balance in your allowance left over from the prior month. And this was part of the reserve for those sales that you made months ago. In this particular case, we figured out that the current month's addition, right, like we calculated over here, is $800. We debit the expense account. We credit the allowance for doubtful accounts. And I want to emphasize this one more time. This is the only time that we post to an expense account on this. Okay? For some reason, students always, later on when we say, okay, now that we're deciding to write something off, they try and write it off to expense a second time. And I want to be very clear that that's not how it works, okay? Good? Okay. We know the answer to this. Property, plant, and equipment, right? That's all of the buildings, land, equipment, trucks, tools, office furniture, computers that a company needs to operate, right? It's a long-lived asset. How do we match the cost of that asset with each of the accounting periods that they generate revenue? Depreciation. We did depreciation already, yes? We did, okay.
So you depreciate property too?
And we didn't cover this in this class, I think, but in my class last night we had to have a conversation about it. If a company buys a building, there are two components to a building. The actual structure and the piece of land it sits on. Does land, the building over time, the paint peels, the windows start to leak, things happen to it, the roof goes bad, so it depreciates, right? You kind of use it up over time. Maybe it takes 40 or 50 years, but you use it up. Do you ever use up land? No. No, that's different. We won't go there. Land doesn't depreciate, and that's the point I want to make. So think about it. If you had a parking lot, bad example. You had a piece of dirt, right? It's just a piece of land. There's nothing there but dirt. Does it ever really change? Is it ever really worth less because it just kind of falls apart and turns to dirt? No, it's already dirt. Okay? So we don't depreciate land, but the building itself, you have to split out the cost of the building and the part of what you paid, that's the cost of the land, and you just depreciate the building part of it. Okay? Okay. We had some other types of adjustments on our worksheet back in chapter 5. I think it was 5. Prepaid rent, prepaid insurance, inventory, depreciation. Were there any others? That was pretty much it. Some new ones that I want to talk about. And we've been working on these. Remember we did all the 3 chapters on payroll. Accrued salaries. We've talked about accrued wages. Think about it in the most simple way. This month is May, there's 31 days, right? The 31st of this month falls on what day of the week?
Friday.
Friday? Does it? Okay, bad example. No, it works out. This month, the 31st falls on a Friday. If we pay our employees once a week and we pay them on Friday, the timing lines up perfectly where I record the expense and it all is attributable to the month of May. It all is May's expense. Now, what about a month where the end of the month fell on a Wednesday? Part of what you're going to pay your employees on Friday is to cover Monday, Tuesday, and Wednesday, which belongs in May, and Thursday and Friday belongs in June's expenses on your income statement. How do we deal with that? And that's where we accrue the wages for Monday, Tuesday, and Wednesday. Again, it's like doing that estimate on how much utilities expense we're going to have. Okay? I'm going to actually erase and throw an example up here. But we're going to enter this on the worksheet. So that it gets recorded in the correct month. So let's say our company, we always pay on Friday. And this Friday, we're going to pay our employees. We know that our wages expense is going to be $1,000. How do I know this? Because I know everybody's going to work 40 hours. I know what their pay rate is. It's always $1,000 every week. Okay? Sometimes it varies a little bit, but you can estimate it. If the end of the month, EOM, is on Wednesday, how many days are in May? No. At the end of the month, well, hang on. This is Friday. The blue line is Friday. So there's 5 days in this week. So your employees work 5 days, 1, 2, 3, 4, 5, and they get paid on Friday. Yeah. 3 of the days are in May, 2 of the days are in June. So what I want to do is take $1,000 times 3 divided by 5, 3/5 of it go into May, and 2/5 go into June. You're going to split up your expense now to record the wages in their proper period. Everybody see what's going on? So on May 31, if it's going to be a Wednesday, we're going to make this entry. What is it? 3,000 divided by 5, it's $600. So 600 goes in May, and 400 goes in June. So on our worksheet, we're going to make this entry that is wages expense of $600 and a credit to what? Anybody? This is your chance. It's a liability account. Wages or salaries payable. I've heard it called accrued wages payable. I just drop the accrued and call it wages payable. Good? So on Friday when we make the payment to these people, this is on Wednesday. On Friday, when we pay the employees, what are we going to record? First thing is wages expense, because we have to record those 2 days that were in June. So we've got a $400 debit. We've got a debit to wages payable for $600. And we've got a credit to cash for the whole $1,000. And there you go. That's the entry on Friday. At this point, my wages payable account balance is what? I credited 600, showing the liability. I debited 600 here. What's the balance in the account? 0. Everybody with me?